Welcome to the computer screen where I'm going to break down this automated risk management spreadsheet, which is really going to help you guys when you're getting into the market, because it's going to teach you how to control your risk to make sure you never receive a margin call on your account. Your account's always protected, and you're going to learn how to use volatility analysis to understand how much space you need to leave the market to fluctuate by over different time periods, whether you're trading on a daily basis, a weekly basis, or a monthly basis. You're going to have the volatility for all the currency pairs, all of the stock market indices, the commodities, cryptos, for an example, so on and so forth. So if you're going to be trading currencies, guys, we need to understand when you're trading a currency, whether you're trading a commodity, whether you're trading Bitcoin, whether you're trading stock market indices, you need to understand how much these instruments fluctuate by on a daily basis, on a weekly basis, or on a monthly basis. So we know where to put our stop loss and our take profit targets. Because most importantly, when we are trading, we know that we have to use an intelligent risk to reward ratio to help our accounts grow over time when we're trading. So let's say, for an example, we have a trading account where we are only risking say 5% per trade on a given commodity or a currency or a stock market that we're trading. So let's say 5% of our $10,000 account, let's say 5% is $500. Then we're aiming to try to make on a winning position 3 times as much as a losing trade. Because if we took 10 trades and we lost 5 and won only 5 of a 50% win ratio, we would still make a 50% return on our money if we have a 3-to-1 risk to reward, because we're risking 5%, but we're making 15% on a winning trade. So what that basically means is the moment you win one trade, you then have to lose 3 trades in a row just to break even. So let's say, for an example, you win 3 trades in a row, you're now in a really comfortable position that you now know you'd have to lose 15 trades before you used to lose your previous 3 trades worth of winning. So using an intelligent risk to reward is very important. And in this section of the spreadsheet, I've looked at the different risk management parameters when you're using smaller risk per trade. So here we have 2% risk, here we have 5% risk, then we have risking 10%, and obviously 15% and 20%. Obviously, the gains are much bigger when you risk more, but as I've shown you in this spreadsheet, the margin calls come much quicker when you're risking too much of your account on trade. So whatever you do trade, you want to be trading with a minimum of 2% risk per trade and a maximum of 5% risk per trade, because it means you have to lose 20 trades in a row before you lose your money, or if you're risking 2%, you have to lose 50 trades in a row before you lose your money. But when you start trading 15% and 20% risk per trade, you really run the risk that if you lose 2 or 3 trades, you've lost nearly 40% of your account, for an example, or 30% of your account. We don't want to be doing that. That's too reckless. Investing is about building wealth in your trading accounts. So in this section here, I've just given you an example. If you have 5 losing trades, you lose all your money. If you're risking 15%, you have 7 losing trades, you lose all your money, for an example. But when we start to go lower in the amount of risk we take, it takes a much bigger margin for us to receive a margin call. And when we use the risk to reward in our favor as well, we can clearly see, and this is when it really does work in our favor. So let's say you take 10 trades, you only win 50% of your trades, and now you're about 50%. Okay, so clearly, guys, this risk to reward will really help you when you're getting into the market. So have a look at this section in the spreadsheet, and you will see that you should be trading around 2% risk or 5% risk as my recommendation. Obviously, you can risk more if you want to, but it's just not advisable. So in this section, as I go back to you guys, when we look at Euro USD, for an example, we need to know how much does Euro USD fluctuate by on a daily basis, which is the first percentage that I've got in column B. You have in column the second percentage is on ATR volatility on a weekly basis, and the third is on a monthly basis. So what this is basically telling you is how much does Euro USD fluctuate by on a daily basis, on a weekly basis, and on a monthly basis. Because if we're going to go into the market, so look to buy a currency pair, we need to know where to place our stop loss to give the currency pair enough room to fluctuate by over that time period historically, to understand where to place our stop loss. And these numbers are coming from my ATR volatility analysis, which you can buy the spreadsheet from my website. If you look at the video for free, have a look at the video. It goes through this in-depth analysis of looking at the currency pairs, daily volatility going over 10 years, weekly volatility over 10 years, a monthly volatility over 10 years. And these are the numbers that it spits out with you. And you can't argue the numbers because the numbers are calculating this volatility over a 10-year period. So it's really helpful to get these spreadsheets and understand how they help you understand the volatility of a currency pair over a 10-year period. So we have all the US dollar pairs, all the euro pairs, all the pound pairs, Japanese yen pairs, we have commodities, we have crypto, we have stock market indices. So let's say, for an example, we want to buy a currency pair. How is this spreadsheet going to help us? So as you can clearly see here, guys, we have two different sections for buying currency pairs. We have the first one here and the second section here. All we are ever doing is when we're entering a trade to know where's the place our stop loss, how many pips that is, and then where that's going to tell us the place our stop loss, where's the place our take profit target with a 3-to-1 risk to reward, and then you can put in your trading account balance how much you want to risk as a percentage, and it's going to calculate automatically how much you have to place on this trade based on how much risk you want to take and where your stop loss has to be. So let me give you a prime example. Euro USD. The monthly ATR is 3.57%. So that's how much this currency pair fluctuates by on a monthly basis. So let's say I wanted to buy the Euro US dollar exchange rate right now in the markets. Where would I have to place my stop loss to make sure that the currency pair can fluctuate by that 3.58%? So what we do is we have the entry price here. And all you need to do in a spreadsheet is just know where the entry price is. And I'm going to show you how it literally spits out exactly the answer you need. And then we're going to compare the spreadsheet to the answers we get on a chart. And you'll see is literally exactly the same. So the monthly volatility is 3.57%. So let's just get that up on here. I'm going to compare the spreadsheet to what the chart is telling us. 3.57%. Okay. 3.56%, which especially that. So what we need, guys, when we're going into this spreadsheet, all we need is the currency pair entry price, which is 1.2058. So we come in here, we type in 1.2058, which is the exchange rate price of Euro USD. We know the monthly volatility is 3.57%, as we got the answer right here. And as you can see, guys, I've highlighted in this spreadsheet the columns that you need to fill in to get your answer. So you type in 3.57% and it automatically tells you that 3.57% is 430 pips from the entry price. That's where your stop loss would have to be, giving it a 1 month volatility. 430 points. If you get the chart up, we get the exact same answer, 430 points. And then you come in here again, you just type in 3.57%. And what this is basically doing is telling you where your stop loss has to be here for a 3.57% stop loss, and then where your take profit target is going to be here using a 3-to-1 risk to reward. So they tell you your take profit target has to be 1.33%, where your stop loss has to be 1.162%. And let's see if that's right. Yep, 1.162% is where your stop loss has to be. Now, all you have to do then is come in here, type in your account balance, how much you want to risk per trade. So let's say 5%, quantity saying always put 10%, and it's going to automatically tell you your pip value based on the amount of points that the stop loss is to how much you can place on this trade. So if it's 5%, then you're going to risk 1.6. So you're going to place on this trade £1.16 per point if you're trading this currency pair. If you want to sell the currency pair, you literally do exactly the same thing here, guys. You come in here, you type in exchange rate price, which we have here, which is 1.2058. So you go 1.2058. And it's automatically going to tell you that the stop loss is 402 points. So let's see if that's right. 402 points. 402 points. Which is the 1 month volatility stop loss of around, sorry, I've got an run rate point of 3.57%. My apologies. So 3.57%. 3.57%. We can clearly see stop loss has to be 430 points. We can clearly see here when it's 3.57%. 57%. There we go. 430 points. It's telling us automatically our stop loss has to be 1.24. Yep, that's our stop loss, 1.24. And our take profit, we're free to our risk to reward, has to be 1.07. Let's use our free to our risk to reward, which is 10.71%. As we can clearly see in this column, 10.71% is a 3-to-1 risk to reward. And that's going to automatically tell you where your take profit price has to be, guys. So 10.71%. So this spreadsheet, guys, is going to automatically tell you where you want to be getting in and out of the market. So this price is 1076. We can clearly see the price here is 1076. So it literally gives you the answer immediately. So whenever you're trading a currency pair, which is rounded off to 4 decimal points, this is the column you use here. You use the first column in a currency pair for selling an exchange rate and the first column for buying an exchange rate. Now, if the currency pair is rounded off to the 3rd decimal point, like the pound against the Japanese yen, so let's get out the pound Japanese yen. You do exactly the same thing. All you have to do is see where's exchange rate right now, 151.680, 1.51.680. We come over to our ATR volatility. We scroll down. We see how much does a pound fluctuate buying against the Japanese yen. If you're trading over a monthly period, 4.76%. So we come across and we type in 4.76%, 4.76%, which is what our monthly ATR volatility is telling us. Then we know automatically if you was to buy the currency pair right now, if that was what your analysis was telling you, you know your stop loss would have to be 722 points at 1.44460. Now let's have a look at this right now. 4.76%. So let's get the exchange rate price. Let's put to 4.76%. 4.76%. So it's telling us the stop loss has to be 144,481. And look, that's exactly what our stop loss price is here. It's literally to the T. Take profit price, as I've shown you, is automatically calculated for you. So again, all you do is you highlight, you enter the columns which are highlighted. The exchange rate price, the volatility, you get a volatility again. The stop loss in pips automatically is calculated. So is the risk 3-to-1 take profit target, and then your stop loss and your take profit price is given to you automatically. Again, put in how much you want to risk, and it's spitting out through the answer of 0.69%, which is easy. If you do 0.69% times 722, you're going to get your answer of risking 5%, which is 500. So it literally calculates everything for you. Don't worry about this section down here, guys. This is for my advanced course members. So unless you've taken my course, you won't need to worry about these sections here. But now you know you have all the currencies, pairs set up for you now for buying currency pairs, selling a currency pair, and you have the volatility analysis here. It's exactly the same for indices. Let's say you want to trade the UK stock market 100. So the UK FTSE 100. We look at the UK stock market. We know by looking at our ATR volatility, but the UK stock market fluctuates on the month-by-month basis by around 10.85%. So if you wanted to buy the UK stock market, we come in here, type in 10.85%, type in 10.85%. Again, all we need is the exchange rate, the stock market price where it's trading right now, which is 6988. So we type in here 6988, and it spits out our answer telling us the stop loss of 10.85% is 7,582 points. So let's see if that's correct. What was it? 10.85%. So 10.81%, 10.8. I can't get it exact, but it's around 6228, and clearly see the stop loss is telling us 6229. So you can clearly see, you guys, it's given you an exact stop loss area. So when you're placing this order into your MetaTrader app, you know you can type in the exact number and you're going to get exactly where you need to be, and then it's going to spit out for you where you'll take profit target, who's using a risk to reward of 3-to-1. But again, you come in here, put in your account balance, how much you want to risk. It's going to tell you exactly how much you'd have to place on this trade, because if you times 0.07 by 7,000, 582 points, you're going to get exactly 500. Again, if you're selling a current indice, you do exactly the same situation. So let's look at the stock market of the United States. 11.20% is the average 1 month volatility of the S&P 500. So let's just say we want to sell the S&P 500 for an example. We can do the same calculation here. So what is the actual price of the S&P 500 as we speak right now? Let's look at the SPX. So we can clearly see, guys, but in this index market, it's trading at 4192%. So we tap in 4192.7, and we know the average volatility of this ATR is 11.2. So we're just typing 11.2. So we know if we're going to sell this index, our stop loss has to be 4,696 points for my entry points. Now let's see if this is correct. So we need to go, if we're going to sell this, for an example, 11.2. You just go here, remember it's 11.6. I can't get it exactly 11.2. We get an answer of 4654, and we can see 4662. So you know you can get the exact answer here to put into your apps to get the exact stop loss. But you can clearly see, guys, it's very, very close. Oh, sorry, I need to bring up a bit further. I just realized, apologies. There we go. That's as close as I can get it. 4659, 4662. So it's a couple points off. But there you go, guys. You now understand exactly where to place your stop loss. So really helpful, guys. You have the indice sell price here if you're going to sell it, and then obviously if you use to buy the US stock market, you just put in the buy price here and the same stop loss, and it'll automatically tell you where to place your stop loss and your buy order if you're buying the market. So again, guys, you have the buy side and the sell side here automated for you. It's the same for commodities. One thing I will tell you, though, is when you're trading commodities like copper or anything that is traded, for an example, like copper is $4.51. When you type in copper here, you don't type in 4.51, you just type in 45148, which you can clearly see here is the price of proper copper. You just type it in as a full number, and then it's going to calculate the calculation for you. So let's see what copper's ATR volatility is. We can clearly see for copper that the average monthly volatility is 10.46%. So we come in here and we type in 10.46, 10.46, and if you get the price of copper now, it automatically tells where our stop loss has to be, and we can check this right now if you want to. So we go and see where 10.46% is. So come here, 10.46%, 10.46%. Whoops, sorry. This is 10.46%. And you can clearly see, guys, 10.41. So 4 points are close. I can get it. 4.044. And then clearly see here 4.0425. So you can't get it exactly unless you type in this exact number, and you will get the exact 10.46. So if I type in here, for example, 404.0425, you're going to get that exact answer of 10.46%. So again, it's saying it's 472 points, and you get the exact answer here, 472. Just remember, it's just not written as a 4.72, okay? So there you go, guys. That's exactly how you get your stop loss in points, and then again, you just type in here how much you're placing on the trade, and it's going to automatically tell you how much your stop loss has to be, and you have the same on the sell side here. But if you're trading another commodity like gold, for an example, all you do is just type in the price of gold. So let's see where gold is trading right now as an example. So gold is currently trading at 179.2 spot 076. That's the price of gold at this moment in time. So what you want to do is, if you're going to be buying gold, actually, sorry, I wrote this wrong. 1792.07. What is gold stop loss? We know that gold stop loss is, Whoops, sorry guys, I must make sure I just wrote that correctly. Apologies. Yeah, here we go. Sorry, apologies. So it is 1792.12 is the current price of gold. Gold's volatility ATR on a 1 month basis is 8.97%. So we just go over here. And again, guys, we'll just type in 8.97%, and it spits out our stop loss or our take profit price. And again, we can check this to see if this is correct. And it will be. So the stop loss area of his 8.97%. So for the buying gold, 8.97%. 8.97%. Stop loss price is 1632. And we get exactly the same answer here. And we get our 3-to-1 price here. So again, all you do is just then type in your account balance, how much you want to risk. It can tell you have to place a trade of 0.06 pence per point to use this 1 month volatility and allow the market to fluctuate by the 16,000 points it has to have this 1 month volatility. As you can clearly see here, 16,000 points to protect your account. Exactly same for crypto, guys. Just come in here, put the crypto price, put the volatility, and it automatically does the calculation for you. And again, it tells you how much you have to place per point in the market. So guys, it's really important that having a spreadsheet is really going to help you manage your risk. All you ever have to do is just have two prices. What is the price of the asset? What is the volatility over a monthly basis, or if you're trading a weekly basis, or if you're trading a daily basis? You put the volatility in here. It spits out where your stop loss has to be, where your take profit price has to be, how much you paid to trade, and then you now know how to pay to trade in the market. Please use the spreadsheet. It's so important. Have a look at the margin calls, because you don't want to be risking a lot of your account on a single trade, especially anything like 20%. And that is why I'm telling you guys, this spreadsheet here, where you put in how much you want to risk, is going to save you from putting the wrong amount and end up getting on the wrong side of a trade and losing a lot of money, which I really don't want you to do. So again, guys, put any questions about the spreadsheets and the ATR volatility. So over here, guys, when you do get the ATR volatility spreadsheet yourself, you will know automatically, guys, that these spreadsheets are calculating the volatility automatically. So let's say we look at USD pairs. Let's say we look at the metals. The ATR volatility is calculating all of this data. For example, we're looking at the US dollar, Swedish krona. And clearly see is looking at over a monthly basis the data going back 10 years from March 2021 all the way to March 2011. This is the data that this spreadsheet is calculated. So it's 10 years worth of data. It's really important, the daily, the weekly, the monthly, and it's spitting out the answers over these periods of time. And you can clearly see the answers over 6 months, 1 year, 2 years, what the volatility has been going over a 5-year period. And we have this for all the US dollar pairs. We have the volatility analysis for all the yen pairs, the pound pairs, the euro, the metal prices, crude oil prices, stock market indices, crypto. This is where the data in that spreadsheet is coming from. These spreadsheets are automated, and I'll be updating these on a monthly basis, and then you'll be able to re-download this spreadsheet every month and get the latest ATR volatility. So make sure that you use this, guys, because if you don't understand how much something fluctuates by over a given period of time, you may be right in the markets, but not know where to place your stop loss, and you're going to get caught out and you're going to end up losing money because you just didn't know where to go into your stop loss. And this is why this assessment is what the hedge funds use, investment banks use, professional trainers and investors use this volatility analysis, because it's the raw numbers that you can't argue with going back over 10 years that's going to save you money and help you not lose money when the markets go against you. Because as you know, markets fluctuate. I want to give you some examples here when you look at moves in crypto, for an example. So let's just say, what's the crypto? So volatility for Bitcoin is about 35%. So let's look at Bitcoin and let's see how big the price swings are in Bitcoin. So when you get declines in price, you get 30% here, decline in price. What's the decline in price here? 25%. The latest decline in price was around 28%. 20%. So you can clearly see here the average has been around 35%. So what this basically does is when you place a stop loss on a trade, if you do get these 26% moves, 30% moves, your stop loss is going to be wide enough to allow the market to fluctuate how much it usually does without getting caught out, hitting your stop loss. But most importantly, when these volatility analysis over 1 month period happen now, this is even more attractive for us. Because let's say we know Bitcoin's in a very bullish trend. Let's say we get a nice 30% pullback and then prices start to move high, that we automatically know this is a perfect opportunity to get into the market because we've had a nice pullback, we're getting in at a better price, and now let's say we have our 30% stop loss from the price that we get in. Now we have a very low chance of losing because it's already fluctuated by the average it does on a monthly basis. And if it does without another 30%, well, maybe the trend just completely ended and we're wrong anyway. But we'd rather get in here, have our stop loss 30% from the price here. Note that's already declined 30%. We already know that that's how much it fluctuates by on average. And if the bull trend is still in play, then we're going to just catch this trend all the way up and we have low risk of buying a currency pair. So we obviously know that we want to be buying a trending market on a pullback. So just really protect your account, guys, when you do get into these trades and you catch these pullbacks once they've moved on average. For example, on how much they move, we can have a look at I don't know, gold for an example. How much does gold fluctuate by on this volatility analysis? It fluctuates by around 8.97%. So let's see how big the pullbacks have been in gold. So recently we've had pullbacks in this downtrend. And let's see how much prices have pulled back in. So this pullback here, we had a pullback of around 6%. This pullback here, we had a pullback of 9%. So if you knew straight away that because that this trending market has pulled back around 7%, which was the volatility analysis. So let's say what's here, 8.97%, so 8.57, 8.97. So look, guys, it literally moves exactly how much the volatility is telling you. So if you place a trade here with a stop loss of 9%, there's no way you're going to get stopped out. You want to keep getting this trend on the way down. How much has the recent pullback been? 7%. So guys, you will clearly see this really does work. When you really go back and look at currency pairs, look at stock markets, have a look at the volatility, how much they're declining by, you're going to really see that this volatility really does work. How much there was a decline here by when it declined? It declined 15%. But even if he bought at 9%, which is what he really does, if I should buy it on average, sorry, let's get from the top, not from the wick. So let's say it did decline by 9%. Even if he bought at the 9%, your stop loss, even if he bought here, your stop loss was so wide, you were still protected from getting in at that price. And the moment you started to see the currency can move even higher, you would have bought and your stop loss would have been protected. So guys, it's really important to get this volatility. Once you do get this analysis, guys, it's amazing how much it will protect you from moves in the market. I can't even stress enough how much this will really save you from losing money. Let's pick up one more example. Let's look at the S&P 500. The S&P 500, the average volatility stop loss on this is 11.2%. Let's see how big the pullbacks have been on average in this bull trend. So here we had a decline of around 8%. Here we had a decline of 10%, exactly 11.2%, and including we had 10% here. We had another decline here of around 6%. For an example, guys. So again, you can see, guys, when you get these pullbacks, when you start jumping in around these 10% volatilities, you're not going to get stopped out the market because the market's already moved on average how much he moves by on a monthly basis, for an example. So again, guys, you can see this really does work. Use his volatility to your advantage to stop you blowing your accounts, stop you from losing money, and knowing exactly how much to place on the trade because it's automatically calculating for you this analysis, guys. So hope this makes sense. Hope you enjoyed this video. Grab the download from my university page and get it heard in a spreadsheet. It's really helpful for you guys. Thank you for watching, and I hope you enjoyed this video.